So when you do Section 179, there's a limitation because you can't get a net operating loss. So just for example, if I have a business that has a $500,000 net income and you guys go out and buy $1 million asset, we're not going to take Section 179 on the $1 million and get the deduction so we can lose money. Section 179 says, nope, the only tax deduction you can get is to bring your net income down to zero. So just keep that in mind when you're making these decisions with your CPA, is to balance those two out, because right now, net operating losses aren't going to give you dollar for dollar offset because they can only do up to 80%. So just a important thing to note. Okay. So one of the things that the government did, which is really more of a technical statement, is the expansion of qualified property. Really what this is doing from our perspective, from the bank's perspective and investment bankers' perspective, is we're going to start seeing more of a trend to do a business asset acquisition, because now they can write off a lot more of the assets that they're buying. So if you're a business that's considering buying another business, this is going to help you because you can move more assets that can qualify for Section 179. Okay? So again, 336, 338, H10 elections, for those of you that ever done mergers, it's a stock for stock acquisition. You can actually elect as an S corporation to buy another company and deem it as if it is an asset purchase. So the seller gets the benefit of long-term capital gains. The buyer gets the benefit of actually adding assets to the books, even though they just acquired the stock, and depreciating them, which gives us the ability to do what? To take Section 179 and give them a nice tax deduction for the year of acquisition. So our expectations is we think this is going to be a good incentive on this on the small M&A market for businesses to acquire other businesses, because now the tax deduction appeal is going to be easier to achieve. Yeah. So one of the things we have with depreciation on the cars, this is what you're allowed to write off if you buy a sedan. If you buy a sedan, you can't just write off the car under Section 179. Now, does anybody know what kind of car you can buy and get a Section 179? SUV, exactly. So mid-size SUVs are not considered luxury automobiles, even though some of them are really nice SUVs. They're considered trucks under the tax code. And last year, we had probably about 10 clients that went out and bought SUVs in December as a tax deduction. So keep in mind, SUVs, you can actually get deductions on them. Four-door sedans and nothing that's like, that is non-truck classified is there. Anybody has a question, we actually have a listing of all cars that qualify because there's weight and certain limitations. But the nice part here is you still get a nice deduction of $10,000, $16,000, $96,000, and $57,000 if you get a luxury car. And therefore you can get it. And remember, you can buy a car and you can also lease a car, and we're going to cover leases later on. Equipment, all of those things are really make it easier for computer equipment not to be listed property, which means I don't have to worry that much about personal use versus business use. We just can expense the whole thing.
Joey?
Yes?
So all these depreciation rules apply to C-Corps or pass-through?
Yes, these depreciation rules are universal. They're not entity specific. That is correct. Okay, so auto leasing rules, that's the other thing I wanted to cover. The rules that they have now is that if you take the standard mileage deduction on your auto lease, okay, you cannot go through and take the lease expense, which is very interesting. The rate right now for 2018, I think, is 54.5 cents per mile is the deduction. So tracking your mileage is very important, because you can say, hey, I drove 15,000 business miles, either claim it as an expense report or just get reimbursed for it and be able to get that deduction. And this will become even more important because there's changes even to meals and entertainment deductions and some other things that we are used to getting reimbursed for because they're quote-unquote tax deductible. That has changed. So again, if you use the standard mileage lease, the lease payment amount is no longer tax deductible. So we're going to typically actually get to side on the standard mileage deduction, but sometimes people will have very expensive tastes, so we'll do the lease inclusion as an alternative. And we just have to decide which way we want to go for our clients. Okay? Leased vehicles are not depreciated. Again, they're written off as part of the corporate expenses. So you really want to make sure that you're comfortable with those things from that standpoint. Okay? So The other issue is there's a threshold for leases, which is $19,000. And we'll do the lease inclusion, but typically, if you buy a car for 3 years, or you lease a car for 3 years and intend to replace it, and you don't drive more than 20,000 miles a year, you're pretty much a leasing candidate. We look at car leases as a business decision first and a tax benefit second, not the other way around. So don't go through and try to lease a car just for tax purposes. Okay? Yes?
Are there similar rules for leasing equipment, like manufacturing equipment?
Well, manufacturing equipment is easy. It's 100% tax deductible. That's a no-brainer. What you got to look at is, are you buying the equipment with a $1 buyout, or you're just leasing the equipment at the end of the lease, you're going to send it back? If you're buying the equipment with a $1 buyout, you have what is known as a capital lease. You actually bought the equipment, and we'd have to actually capitalize it and then take Section 179 on it. Okay? All right, so there's some other things in here I'm not going to necessarily cover in great detail, but there's qualified lease improvements like we talked about that allow people that want to build up restaurants or build up retail stores to do 15-year lives on these leasehold improvements, i.e. walls, ceilings, electrical, those kind of things. So that, again, helps business owners really get a deduction. So now we're going to get into something that we're going to spend some time on, and that is the Section 199 deduction for qualified business. So this is where you definitely want to pay attention. Okay, so what you have on LLCs is that you have a business that can be a C Corp, can be a sole proprietorship, and can be an S corporation. It just depends on what box you check. Okay? So if somebody has a single business that is what's known as a single member LLC, they're going to be a sole proprietor. They're filing a Schedule C. If they get a partner, they can say, hey, I want to create a partnership. Or no, I want to create a C Corp. Or I want to create an S Corp. So LLC doesn't define anything. It's sort of like a chameleon. Does that help? So when we get to pass-through entities, what you're dealing with is partnerships, and you're dealing with S corporations, and to a certain degree single-member LLCs, i.e. sole proprietorships. But when you look at Section 199, this gets into the meat of the issue that we have right now for you guys to cover. So first option, there's a lot of people who have been talking about converting from S Corp to C Corp because C corporations have a 21% tax rate, right? Well, that's good, but the whole point is that really you may not want to just move from a C to an S, and we're going to cover that later on. So I just want to make sure that we are going to just stick right now to the topic of S corporations and partnerships and get those covered. So first and foremost, the new law gives you a 20% deduction off your QBI, qualified business pass-through income. And therefore, if, for example, if you're going to make $100,000 of income QBI, you're going to take 20% off, and you're only going to be taxed at the $80,000. So it's a pretty good thing to be able to qualify for it. But of course, like anything else the government creates, there's a maze of things that you're going to have to go through, and we're going to try to explain it to you. So first, QBI does not include any capital gains. Okay? QBI does not include certain investment income. You can't get a 20% deduction on it. And reasonable compensation and guaranteed payments are not part of QBI. So this is what you have to deal with when you're going through and understanding the new law and how it works. What is a pass-through entity? Question. It's really all of these. If you have disregarded entities, i.e. single-member LLCs, multi-member LLCs, trusts, REITs, S Corp, C Corp, etc., all of them really fall under this rule. And therefore, you should hopefully be able to take advantage of that. So, the QBI has certain limitations in it, and we're going to try to give you guys some instructions on it on how that works. Because the limitation does not apply as long as taxable income is at a certain level. So the line item you're looking for your QBI is line 43 of your 1040 starting in 2017 as sort of the litmus test for you. So you may not know what QBI means. Your accountant will know what it means. And line 43 of the 1040 really is where that test is going to be, because the government, again, said we want to benefit the small business owner, and they set a threshold of 157.5 for single individuals and what is it, 317 or 15 for married filing jointly. And there's a phase-out aspect of it. So if you are single and you make 157 and you start making more than that, once you go over $207,500 on your line 43, you don't get the 20% deduction. And if you're married filing jointly and you go over $415,000, you don't get the 20% deduction. Okay, so sorry to be the bearer of bad news. So again, Section 199A has another set of limitations, which are for individuals that are what are called service providers. So if you are making money and you're saying, oh, great, I'm going to get the 20%, not so fast. If you're a CPA, you're an attorney, so we'll pick on the speakers first. Paid athletes, performing artists, or, which the IRS likes to always do, is they like to have declarations. Anybody that provides a principle where the assets or such trade or business is based on the reputation or skill of any one of its employees. I don't know what that means. So when we looked at it and we started looking at the recent articles that came out, it really is saying that unless you're excluded specifically from this, you're basically going to fall into professional services. So if you're a retailer, you're okay. If you're a wholesaler, you're okay. You rent out real estate, you're okay. If you're a consultant, you're not okay. If you're an attorney and a CPA, you're not okay. If you're a professional athlete, even actors, they're not okay. Okay? Is that okay?
Yeah.
No? Maybe? Susan? Home inspectors, that would be a service right now, unfortunately.
Yeah, I think this is one of the areas we're going to talk in a few minutes a little bit more about the lack of clarity and how that's going to get resolved, and this is one of the biggest areas of it. But yeah, there's been a lot of questions about, for instance, what falls under health. I mean, I saw some examples of a doctor's practice. Okay, that's probably covered. What about a health club? What about a fitness club? You know,
Exactly.
Is that different? Consulting, obviously, what does consulting cover? And, you know, the last one about the reputation or skill, it's sort of like how famous do you have to be covered by this? So
Yeah, exactly.
a lot of questions.
And like what Susan is saying, we are going to delve into this a little bit more, so we're just giving you guys the overview. There are some people that somehow got, yes, Neil?
One question about this. If the professional is in that limited service protection, but below 157,000 single, they don't qualify.
Yeah, so if you're below, you do qualify because you're below the 157. It don't matter. Okay? Am I right on that one? Maybe. Okay, see, we're not clear on it. I thought you do qualify. So when you go through and you're below 157.5, you really don't have to worry about whether you're professional services or not. You're just going to take the 20% deduction. If you're above, you got to meet the definition of all of these things we're talking about.
What if in a combination of all of those things?
Very good question. We will be addressing that later on. That's one of the things we're going to be dealing with is you can have somebody who's a physician who also owns home inspection business. Well, where does that fall? I own a retail store and I own the store, okay? Or I have a services company, but I own the clinic that I live in. All of those things are part of the things we're going to be discussing because we know this is not, fully baked from a definition perspective.
And also, to add to that, I mean, yes, you first have to figure out what your current structure, how it applies, but this also may offer some planning opportunities. So for instance, if you have a business that's disqualified, can you separate the two?
Right.
Two things that you do within it so that one of the separated entities would qualify.
Yeah, and then we're going to actually cover that. So again, we're trying to explain the law. The planning is going to come, I promise. Then you talked about home inspections. It's amazing. One of the senators decided to exclude engineers and architecture companies. He says they're not service providers. Well, not my decision. That's the Internal Revenue Code that says they're not. So they, civil engineers, electrical engineers, they're lucky they had an advocate for them when all this law was getting baked, and it's outside. Architects, same thing. So if you're one of those, you don't have to worry about this limitation on specified services. Okay? So again, when we go through and we do this calculation, you have to go through and look at the details, and one of the details is how do you now limit the deduction? And this can get mathematically complicated, so I'm going to apologize in advance. One of the things that we had is a portion of the deductions that you have to get has limitations, which is 20% of your salary. And we're going to run through case studies on this. I'm sorry, 20% is the deduction. 50% of your salary is the ceiling. So if you have a certain amount of money and you're making more than the amount of money that is limited, you don't get the deduction. And this will make sense in a second, so bear with me. And then there's another calculation that you have to do, which is 25% of the W-2 plus 2.5% of your qualified property, so that you can also meet that test. Reasonable compensation is going to, yes?
Before you go on, I want to make one point about that. Notice, because this is a bit unusual, it said unadjusted basis. It said unadjusted. I'm sorry. Yeah. On the last slide, one thing that's a bit unusual in the tax code is that last rule said unadjusted basis, meaning you don't take the depreciated basis. So I just want to make a note of that, which obviously will give you a higher cap there.
Yep.
So that's an important point to just make sure you know.
No, thank you. So the issue you're going to have when you say compensation is, okay, well, what is reasonable compensation? If I have a ceiling of 50% of my salary, I'll just increase my salary, and therefore I won't have to worry about the cap. Well, the government says, no, it has to be reasonable compensation. What is reasonable compensation? Good question. One of the things we are looking at is how do you justify a salary of a doctor, retail, whatever, it doesn't matter, of every profession. And that's going to be part of the things we think the IRS is going to have a lot of issue with, because by region, people get paid different amounts. By experience, they get paid different amounts by their skill sets. So it's going to be very interesting to see how that's going to be rolling out with the IRS. If you are in a partnership, you don't earn a salary. So if you're a lawyer, you work in a partnership, you don't get a W-2, you get guaranteed payments. Well, then guaranteed payments are going to have to be determined, and you have to determine what is a reasonable guarantee.